All right. And let me pull this up here.
Are you able to send me those links by chance from last night? Pretty please.
Which links were you looking for?
The ones from James.
The ones that he was trying to send from the
Those thingies. The PowerPoints.
the PowerPoints. Yeah, I can try to, but unfortunately, he hasn't sent them to me yet.
Oh, he didn't put them on the thingy?
No. Well, he put them on the drive, so let me see if.
I'm sorry.
Yeah, hang on one second, because I can actually put them in the chat here for you.
That's what I figured, so I don't know how to. Let me log on through the computer, because if I log on through here, I should be able to print it out, right?
Yeah.
Hey, John.
Here we go.
I'm joining here. Okay. Okay, yay. I was able to join here, so I should be able to see, and then just put it in general chat for everybody.
Yep, there you go. It's going up there to the chat.
Download. Want to open it. Save. Open file. Yes.
Okay, yeah, because that's something we're covering later on.
Oh, we are? Yay. Okay. I'm just going to stay on the meeting for the day.
But not for a while.
Yeah. Thank you.
That's not, because that's not something we're covering on today. So that's something we're covering like in 2 weeks.
Oh, okay.
So, all right. So, Vicki, actually, if you're going to go over that, I would suggest you go over that one.
Mm-hmm.
So, all right. All right. Today, we are going over other deductions and credits. Now, other deductions and credits for business are a lot different than other deductions and credits for individuals. Okay. Other deductions and credits are ones primarily for when you have a type of loss, or if you have to compensate for something that has occurred for the business, and you need to compensate either for a loss for a particular year, or if you had a gain one year and you need to compensate for it in the next year. Now, what's good about that is you can have a net operating loss, and you can actually carry it forward or carry it back. For 2 years, you can carry it back. Okay, so let's get into that just a little bit here. All right, a net operating loss. Anybody can tell me what a net operating loss means? Naomi, Amanda, anything? A net
When I
operating
have a business and I've lost it, instead
your expenses is greater than your income.
There you go. That actually is the exact definition of it. It means that what happens is your total expenditures for the year were greater than your income. And so it results in a net operating loss. Okay, so it's not a gross operating loss or anything like that. It's a net operating loss. All right, now what's important about a net operating loss? A couple of major points. Number one, we're going to cover the C corporation net operating loss when we cover C corps in detail. But a partnership, okay, and an S corp, because they are pass-through entities, they actually pass through to the partners. Okay,
yes.
So what ends up happening is that net operating loss will pass through to their other possible losses or gains. Okay, which is great for them because then it can reflect on the individual taxes. Now, that means that if you had a net gain or a net loss from that year from another corporation, they can actually be added together, because let's say you had a net loss from more than one entity that you were a partner in. you can actually add both those net losses together and possibly compensate for a net gain from another corporation, like a third one. Now, those actually get passed through and they get reported on the K-1s. All right. So what ends up happening is the important part about a net loss for an S Corp and for a partnership is that net loss passes through to the partner's individual returns. For a C Corp, like I said, we're going to be discussing that when we go into detail with the C Corp. But there's a couple of important parts about a net loss you have to understand. Number one, net losses can actually carry forward and carry back. Okay, so let's say this year I have a net loss. Well, I paid taxes because last year because I had a gain. And I paid taxes the previous year because I had a gain. I had 2 good years, right? Well, let's say I had a net loss of, say, $20,000 this year. And let's go into this here. Let me share the whiteboard so you guys can get an idea of what I'm talking about here. All right, now I'll move this down to here. And this down to here. Okay, so let's say that this year I have a, oh, there we go. Let's say this year I have a net loss. Okay, I have a loss for this year. Okay, now what ends up happening is, let's say last year I did really well. I had a gain. The previous year before that, I had a gain. Whoop. Sharing is paused still. Let me resume that share. There we go. There we go. You should be able to see it. You should be able to see it now.
Yes.
Okay. Okay. So this year we have, this is this year. This is the tax season for this year. And this is the previous year and the year before that. Okay. So what happens is let's say that this year I had a net loss of, say, $15,000.
Mm-hmm.
Okay. Now, it wasn't so great a year. I'm not so happy with it, but there is an advantage to having that net loss. Shell took my pen. Shell took my, oh no, she took my pen from my tablet so that normally I could write on this with my tablet instead of my having to use my finger. But she took my pen. So anyways, so let's say I had a $15,000 loss this year, but last year I had a positive year with $10,000 here and a positive year with $8,000 here. Okay, now I had a net loss here, but what happened is I paid taxes on these 2 years, right? Because I had a
Net
positive
income.
gain. I had a net income, so I paid taxes on it. Well, this year, seeing I had a net loss, what I can do is I can actually take an anticipated, I can carry them back 2 years. Okay, so that means that I can actually reapply for the refunds for those 2 years. Now I had a $15,000 loss here, so I can take a $10,000 loss here to carry it back to cover that one, and I can take $5,000 of it because I had a $15,000 loss total and cover 5,000 of that $8,000 gain. And I can carry it back for a total of 2 years. Now that's great when you think about it, because I didn't have, I had taxes I owed. So that means I can get refunds for those 2 years. Originally I had to pay taxes, but I can now get refunds because of this year's actions. Now let's say that I had maybe a net loss on, or I was break even or close to even, or I'm anticipating that the market is going down or something may happen. Okay, I'm anticipating something of nature. So I don't know how the market's going. I don't know how the season's going to go? Who knows? Okay. So what I'm anticipating is maybe that next year I may have a loss. Well, instead of carrying it back, okay, I can actually carry that loss forward. In other words, what will happen is I can carry an amount that goes forward in anticipation of gains. Okay, that I'm anticipating, maybe I'll have a good year next year.
Mm.
Okay, so I'm something will happen with the market and I will have a great year, or I'm anticipating I'll have, things like that. Or I had a year where I had a rebuild year this year, right? We had remodeling done, we had things where we had a lot of expenditures, so we had a net loss. So our expenses were very high, and so we are, say, $20,000 as a net loss this year, but as a result, we're anticipating that our customer growth will be huge, right? Or we spent a lot on marketing this year that we're hoping will reflect that next year. So what happens is that means that this year and possibly this year, we're expecting growth. Okay, so maybe this year we have a net loss of, say, $20,000 this year, but we're possibly ending up with a 5,000, a 10,000, and 15,000. Let's say it goes up 5,000 each year, right? So this $20,000 loss, we can wipe out that 5,000, that 10,000, and 5,000 of that $15,000 that we no longer have to pay taxes on because we can carry it forward. And the best part is you can carry it back 2 years, but you can carry it forward up to 20 years. Okay, so if there's an net operating loss, you can carry it back 2 years, but you can carry it forward up to 20 years. All right, so that's great. If you have a rebuilding year where you have a net loss for a year.
But Ryan,
Yes.
under the TCJA, net operating loss incurred in 2018 can only be carried forward, not back.
Yes, there are certain ones, correct.
But for farming, except for farming businesses.
Correct. That's correct.
And
what happened is because what happened is they changed certain laws.
Yeah.
Now, a farming business actually can also, a farming business can be carried back 5 years. Like I said, there are certain exceptions to this.
But now it's only 2-year carryback.
Correct, but it's up to, but a farming one can actually still be carried back 5 years. They may have an exception for farming communities.
Yeah, it says for farming, it is allowed only a 2-year carryback now.
Okay, that may be a possibility that changed.
Individual section, is that different than for business, maybe?
That I need to double check because the carryback, because normally with the farming, because it's not, it's on the farming, I have to double check because usually in a business return, if it's under the farming guidelines, because under the 2018 guidelines, normally a farming one, yeah, because that may be the difference, because I can't remember if it's, because a farming one is usually
in the individual section, I'm pretty sure I read that too. No, I mean,
yeah,
what she said.
Yeah, I got it from the passkey review for business.
Okay,
I wasn't sure.
Okay, because I want to double, yeah,
and then
it may
if you can verify also the carry forward is indefinitely before it is expiring after 20 years.
Well, it does go forward. It will go forward up to 20 years. Okay.
But now it is can be forward indefinitely. Maybe you should, yeah.
I better double check that for 2018.
Yeah, for us, please. For business.
Because for business, it has been 20 years.
Yeah, and it says, additionally, under the TCJA, the net operating loss deduction is limited to 80% of taxable income. So you cannot wipe out the net income, only 80%.
Okay, yes, I got to double check then because it
Except
had to
for
have changed for
insurance
2018.
companies. Yeah, except for insurance companies.
Okay, then I better double check because what's happening right now is because that's different than what I have for it because I've got all the stuff from 2017 and not the 2018. Because like losses from rental properties, things like that, they are eligible to remove all of it, and we'll have to. We'll have to see. We'll have to,
Yeah, we
that's.
should be cleared for that.
Yeah, we'd better double check on that because it right now, because what I have is it can go up to 20 years following the net operating loss, and I know
Yeah.
that that's not necessarily the case. That may or may not be the case anymore. So I'll double check that one.
Yeah, because I've been reading the PASKI EA review for business. This
The
is what I've
current
read.
one.
Okay.
Okay.
Yeah.
Because farming losses. I know farming ones have been always 5 years back, and they have never had any change in that I know of. So I got to double check that one
Yeah, we
because the
need to be
farms are the special.
updated.
Yes, I will double check on that.
Okay, thanks.
Okay, now there are certain circumstances where they do qualify for a longer carryback period. Now the farms have usually, like I said, always been eligible for a 5-year carryback. If it is a 2017 return, then or 2018 return, it does go back for the 5 years. Then if it's currently, it looks like if it's going to be for a 2019 return, maybe it can only go back to 2 years. I'll double check on that one.
Yeah, okay.
So we'll make sure that we have that up to date. Now, there are certain qualified businesses I do know that are allowed to do it for 3 years for their carryback. Now, there are only a few that are eligible to do it, and it's usually when there's a federal disaster that has been declared. So if they've been out of business for a period of time because of a natural disaster, they do give them usually a 3-year carryback to make up for that period where they were no longer eligible to be working. So I will have to make sure that that one is currently the same as well. Now, casualty and theft, that one, as far as I know, is still 3 years. Okay, that one has been 3 years for as far as I've been doing it, so I have to get up to date if that one's changed. But that carryback has always been 3 years. If there's a loss due to casualty or theft, it has been allowable to be a 3-year carryback. Public liability for losses, public liability losses have a 10-year carryback period.
Public, again,
Now, what it
public
having a product liability loss. In other words, what happens is something happens for an item that ends up in a lawsuit or a recall. Okay, so something happens and they suffer from a loss as a result of it. Like Chrysler has a problem with its cars. Okay, and what happens is they have a problem where their cars are being recalled. They suffer a loss as a result of it. That carryback is actually allowed to usually go back 10 years. It's usually because it is such a large amount that it has been allowable to go back 10 years.
Yeah, it depends upon the cost by the cause of losses.
Okay, yeah, and that's what I'm saying. This one is a product recall or as a result of the lawsuit. So I'll double check on that one as well. Now, there are a couple that are definitely not allowed when figuring a net operating loss. Any deduction for personal exemptions. Okay. So in other words, a personal exemption, if it causes a net operating loss, is not allowable as a cause for a net operating loss. Capital losses in excess of capital gains. Okay. In other words, if one of the things that you have is, let's say, rental properties, and you have sold rental properties during the year, okay, and some of them you had a capital loss on, some of them you had a capital gain on. If the capital losses exceed the amount of the capital gains, and that results in your net operating loss, you are not allowed to count that as a net operating loss. Okay. Capital losses exceeding capital gains is not allowable as a net operating loss expenditure. The reason is, think about it, if you had some properties that you knew you needed to have a capital loss, because people would be able then, if you needed a net operating loss, you could take some of your property you owned and in that particular year basically sell some property for less than their valued amount, take a capital loss on it, and end up with a net operating loss. Okay. That's why they do not allow capital losses that exceed a capital gain to be counted to make a net operating loss. The exclusion of gain from the sale of qualified small business stock. If it is qualified business stock, small business stock, and you suffer a loss from it, you are not allowed to count that. It is a sale of a stock. You are not allowed to count that for your net operating loss. Non-business deductions in excess of non-business income. If you are running a hobby, and that hobby is one of the things that you have expenditures on, like you're running a sole proprietorship, and as a result you have a net operating loss because of the hobby income you have, it is not considered to be counted as a net operating loss that you can carry forward or back. Okay, that cannot figure into your net operating loss. Okay. A net operating loss from another year. Okay, so in other words, if you have a net operating loss from 1 year, it cannot be added in conjunction with a net operating loss to this year. So let's say you carried one forward to this year. Okay, let's say you had a net operating loss this year, and you had a net operating loss from last year. You cannot add the two to make a larger net operating loss. Okay, it cannot. Let's say you're at more or less zero this year. What that's saying is this. Let me clarify this a little bit. Let's say your operating costs would more or less be zero this year, or a slight profit. Let's say you had. Well, let's actually make it realistic here. Let's say that you had $10,000 in profit this year. Okay, you had a gain this year, but last year you had a $20,000 net loss. You cannot carry more than the $10,000 forward to result in a net loss here. So you can't move that $20,000 forward here to end up with a minus $10,000 here. Okay, you can't do that. The most you can move forward is $10,000 here.
Yeah.
Okay, you can't move $20,000 forward to have a net operating loss here. The most you could do is bring this to zero.
Okay. Yeah.
Okay, you cannot move more in excess to it to have a net operating loss for this year. The most you could do is reduce it to zero. Okay. This one is really there is the domestic production activities deduction. This was put into effect in 2004. It was really intended to help businesses stay in the United States, help businesses grow within the United States. So it gave tax deductions, a 3% deduction basically, for businesses that were manufactured, stayed for things like everything from buildings to movies, anything that were produced, manufactured, anything like that within the United States. Okay, that was great. The problem is that 3% deduction. What if you were at a 2% profit, and that 3% deduction could actually give you a net operating loss? Okay, they will not allow that to be used to create a net operating loss. Okay, so that 3% deduction that is usable from the domestic production activities deduction cannot be used to create a net operating loss. Okay, and then a self-employed taxpayer's contribution to a retirement plan. So if a self-employed person, they have the option to make contributions to their retirement plan, and that's considered, in a sense, a business expense. If they are doing that, that cannot be used to create a net operating loss. Now, that can be used to reduce their overall expenses to zero, but again, it cannot be used to create a loss. Okay, so they can contribute an amount equal to, let's say, whatever their profits are up to the limit for a self-employed person for the year. That can be contributed into a retirement plan for them, but they cannot do in excess of whatever their gains were and have it reduce it to be a loss for their business expenses.
But they can bring it to zero.
But they can bring it to zero.
Okay.
Okay. Let me just see here. I'm going over my notes. Oh. Okay. So let's run an example here. So let's say that somebody had a $20,000 net operating loss this year. This is for this tax season. And they had a gain of $15,000 this year. And they had a gain of, say, $10,000 the year before that. Do you think it would be worth them to carry back this $20,000 loss? Or should they carry it forward?
$50,000 is next year.
Well, no, you don't know. You don't know what they have next year. This year they have a $20,000 loss.
Loss, yeah.
Okay, and last year they had a $15,000 gain. And
15.
Yeah, $15,000 and $10,000 the year before that.
Okay.
Would it be worth them to carry that $20,000 back?
Can they split it up at all?
Yes, they can split it up.
15 and 5.
Yep, they
That's
could
what
actually.
I'd say too. No, I mean.
Because that would be the best way to do it. You don't know if you're going to have a gain next year. Okay, you had a loss this year. Maybe you don't know if you're going to have a gain. So yes, you can carry things forward. Why would you do that? You already know you had a $15,000 gain and a $10,000 gain. So you know you got $20,000 you can cover right there. So submit it, cover that 15 and that 10, 5,000 of that 10, and guess what? Get a refund from the past 2 years.
Yeah.
Wouldn't that
Or
be
could
a
you
good?
just carry back the 15 and get a refund from 1 year and carry the 5,000 forward to the year?
Because that's the one thing. You can only carry it in one direction.
Okay, that's what I was wondering.
Yep. You can only carry it in one direction. You can't actually have it carried in 2 different directions. And that's one thing that happens that a lot of people would like to try to do, is carry it in multiple directions. But you can either carry it back or you can carry it forward. You can't do both, carry it forward and carry it back.
Okay.
So yes, otherwise I would do that same thing too. Maybe carry back the 15 for the 15,000 and carry forward 5,000. So, all right.
Okay.
All right. Okay. Now for business tax credit. Now there are a lot of tax credits available for businesses. Okay. Credits are generally more valuable than deductions because what happens is the credits are for a stated amount. Remember, deductions are usually only a percentage of the amount that you have. So if you take a deduction, it's usually a percentage. So a deduction of, say, your off of your taxable amount, it's usually like 70%, 60%, 80% of your total contribution. But a credit has a stated amount. So if it says it's a credit for $15,000, it is a $15,000 credit. Okay, it's not a percentage of it. So credits are usually much more valuable than just a regular deduction. Okay, so it is based on, they actually are dollar for dollar, based on the amount of the applicable credit. So those credits there's a lot of them available. They just have to apply to the right situation. Okay, now they have usually a lot of stipulations. There are reinvestment credits. In other words, if you build buildings or production facilities within certain areas, okay, they have them based on areas. If your factory goes into an area where it needs to have reinvestment, that will count as a business credit. Each one has stipulations, again, like I said, but as long as you follow all the guidelines for it, those credits can be pretty significant. And as they are dollar for dollar, that is awesome, because sometimes the credits can even be a credit such as, a $10,000 credit counts as a $10,000 direct reduction off of your taxes. All right. So that's an important, the business credits are very important.
Is investment credit a part of under general business credit?
Investment credits? No, they're actually a little bit different. General business credits, they fall under the umbrella of most business credits, but investment credits are a little bit different, because there's a certain level of risk for them. So it's not general business credits are not a single credit, but instead of a combination of various individual credits combined together.
How do you earn that?
Actually, we were just about to go into it, so let me go over here a little bit.
Okay.
The general business credit is, they end up on an aggregate form. It's the form 3800, the general business credit. And what happens is it is a combined amount of a series of individual business credits. All right. And that is from the business tax credits, are direct tax credits, where these are a general business credit, are a group of tax liability credits. In other words, they're not necessarily, number one, they're not refundable. So it can only reduce your thing to 0. They're a non-refundable credit. All right, where the actual business tax credits can be refundable. That's the major difference. All right, but they are a non-refundable tax credit, and what will happen is when you specify that they are for construction costs, they can be for tax-related issues, and there's an entire list of them. They can also be carry forward business credits from prior years. They can actually carry forward a number of them. There is a disability access credit. There are, I'm trying to think of the list. I'm drawing a blank right now. But they are a dollar for dollar general business credit. Let me pull up actually the list here for you. General business credits. I can give you the examples here. There we go. Okay. They are incentives for people who run their own business. Okay. What ends up happening is they are to allow you to run a business. They are tax credits and dollar credits, which can only be allowed to lower your tax liability to 0, and they are applied for. It has to be an LLC. You have to have an EIN number. So you cannot run it as a sole proprietorship. Okay, that's one thing, is sole proprietorship cannot get the business credits. And it is regular incentives to allow you to have more cash on hand. So there is a list of them. Most of them involve employment, employing certain types of individuals. That's why it cannot be a sole proprietorship. They are employing minority workers, employing disabled workers, employing convicted individuals. If you have a military background, any of these things will allow you to get an incentive credit. Now, what will happen is if you do so, you are allowed to accept, you get this credit against your taxes. Now, the more you have, the greater the tax credit. But again, like I said, at one point, it will reduce your tax liability to 0, and you do not get to take any additional credit. Okay.
Yeah.
Let me see here. I was looking for the list. I have a list of, each year there is a list of the most common business credits. Now, most of them are a minority credit. In other words, employing either a minority or
You said veterans?
Veterans, correct. Veterans, anybody with a military background. Yeah, they're normally just an employment one for bonuses based upon who you employ. That's the only list I have there, but those are the general business credits. And they do, it can be carried back to the prior year and forward for up to 20 years. Now, again, this was for 2018, so I don't know what it is for 2019. I got to double check. It is able to be carried back prior 1 year and forward up to 20 years. Dang, I'm still getting texts from all these people. I'm getting like 400 texts at one time. It's kind of like all these people are want to apply for our job, which is great, but it's kind of like, guys, I don't, I can't handle that right now. So, but the problem is it all comes into my phone. So, all right. So the general business credit is basically for people you're employing. It's a payroll tax credit or liabilities. Okay. So, all right. So, and it carries forward at the last tax year. I got to double check for the upcoming one. Yeah, it carries forward to that year. It carries forward 20 years and it'll carry back 1 year. Okay. Now, again, the investment credit is different. Investment credit is a sum of multiple credits. The investment credit is available to businesses who engage in specific types of projects on their property. Okay. Let me do this. I've got to answer this email I just got from Frank. Let's take 5 minutes and I'll get right back to you, okay? Because I just got to answer this email to him.
Okay.
All right.
Nangyari.
All right, ladies, I'm back. Okay. Let's take a look. All right. Just so you understand, let me clarify something. The business tax credits are credits that businesses can get for doing specific tasks or using specific people. They're normally a very lucrative way for a business to get money. Okay. In a lot of cases, they are either refundable or non-refundable. Most of them are non-refundable, so you cannot get additional funds for them. But as a result, it will reduce your tax liability to zero. Okay. They fall under, most of them will fall under as a general business credit. Okay. So what ends up happening is you put them all, they all have their own individual forms, but then they all fall under this general business credit. Now, there are some exceptions to that. Okay. And we're going to go into those. One of the biggest ones is the investment credits. Investment credits are a little bit different than a general business credit. Okay. So let's get into what the investment credits are. The investment credits are normally for businesses that are attempting to grow or recover a property where their manufacturing occurs. And what it means is investing in your own business. Okay, so there are different types. There's a rehabilitation credit. Now they end up on a form 34. Let's go to this here. So let me put this up here. They end up on a form 3468. This is the investment credits. All right, and once they then are submitted, it ends up on its own area on the tax form, depending upon what type of tax entity you have, what type of business entity you have. All right, those then, each one has its own investment type. Now, a rehabilitation credit are for businesses which try to save an existing building or retrofit a building. So in other words, they have an older building on the structure and they need to retrofit it so that it's more modernized, or it's a historic building and they want to save it. That's what they're doing for that particular building. There's an energy credit. This is for the types of times when a business will be attempting to apply solar panels, alternative forms of energy, that sort of thing, to their company and start using green credits for their business. Okay, it's a great way to build up this credit. Now, the problem with it is these are non-refundable credits. Okay, typically they unless there's an exception under a specific type, this is a non-refundable credit.
The energy credit.
The energy credits, actually most of the investment credits are non-refundable credits unless they specifically say that it is for this investment credit a refundable credit. Most investment credits are a non-refundable credit. They do make exceptions, but that's on a case-by-case basis for it to become a refundable credit. But most investment credits are a non-refundable credit. They also have them for coal projects. So in other words, one of the major things about an investment credit is when you're actually restoring a building or energy. And that's the biggest thing to remember. In regards to energy, coal is a major source of energy.
Yes.
So what ends up happening is there are, put this up here.
Can you mute Victoria again?
Yeah, that's what I was going to do here. So we have our credits. They are mainly for things like building restoration,
Energy credit.
Restoration. Did I spell it right? Looks like it. Or
Rehabilitation credit.
rehabilitation credit. That's what it is. It's a building restoration is what it is. Or energy. Building restoration. In other words, you're trying to restore a building, either for historic purposes, retrofit it, that sort of thing. Or energy credits. Energy credits. Okay. Energy credits are basically solar, wind, that sort of thing. And finally, coal. Coal has a number of uses. Coal is used in coal-fired energy production. A lot of power plants are coal-fired. So in other words, the coal is used to burn, and then that coal powers the generators.
Generate electricity.
To generate electricity, correct. Gasification is similar to this, only it's basically wood and coal can be used to make gasification. The stuff is heated, it releases an actual burnable gas. Okay, that is gasification is another form of it. And then the advanced energy project credits are reducing the carbon dioxide emissions. So that's mainly what the investment credits are for. They are either building your buildings or improving their energy efficiencies. They have a couple of restrictions. They have to be used within the United States. They cannot claim it if it is outside the U.S., if it is used by a government unit or a foreign entity, used by a tax-exempt organization. In other words, it cannot be used for a church. Okay, anything like that, it cannot be used for a church. So any tax-exempt organization, it cannot be used for. All right. And it cannot be used for lodging or for furnishing of lodging. In other words, it cannot be used for a hotel or anything of that nature. And it also is any property that has already been expensed under Section 179. So in other words, if it's already been depreciated, you cannot use this credit for it. Now, where may that be an issue? What's one of the first things they said that this is used for? Building restoration, especially of historic buildings. Well, what if you have an older building that's already been depreciated and you're looking to retrofit it? If it's already been depreciated, you cannot use this credit for it. Okay, so it immediately is disqualified from this credit. So think about that. If it's an older building, it does not qualify if it's already been depreciated. All right, now again, this is one of those that doesn't just go under the general business credit category. All right, but there are a whole bunch that do. One of the first one that does, and this one's unimportant one because it is where we were talking about what goes under the general business credit. This is the specific definition for all of those people who go to work. Okay, this is the work opportunity tax credit. You use a separate form. It is a form. Let me type it up here because these are all individually different. It is a form 5884, and it is the work opportunity tax credit. Okay, and it is used to report a number of individuals who come to work for you, and each one is a beneficial employee that you get tax credit for. All right, and this includes stuff like unemployed veterans, people who are on TANF, people who are on SNAP, and I'll explain these here. people in empowerment zones. These are really important here because empowerment zones are areas of depression. So what we'll do is let me go over a couple of these things. Ex-Felons. Now that one's sometimes, does anybody know about Dave's Killer Bread? Do you know why it's partially called Dave's Killer Bread? You know, have you ever had that bread, Dave's Killer Bread?
Yes, he created a company to employ convicts because he was a convict.
He was a convict. What happened is, no, he was a convict, and in prison he actually learned, well, number one, they don't cook a whole lot in prison, at least not good food. So what he did was he took everything he could find and started throwing it into the bread. So he discovered they liked all the grains in the bread. So what he did was he took those recipes that he made while he was in prison and he started his own bread company. And to also help the ex-cons that were getting out of prison, that's who he employs. He employs a whole bunch of ex-cons to work for him. And that's most of his employees are ex-convicts trying to rehabilitate their life. So yes, that's what Dave's, and the reason it's called Dave's Killer Bread is because some of the people are felons who have committed murder or had actually killed people. So that's why it's actually Dave's Killer Bread. So most people don't know that. You know, they think it's actually named that because it's great bread. And it is. It's really good bread. And these guys are really trying to turn their lives around. And it is great. You know, they're trying to turn their lives around, and it's a great way to employ them. So all right. So these are people who are summer youth employees. Okay. These are a whole different group of different individuals, people who are normally not employable for various reasons. Unemployed veterans are ones that have come back usually from military action and are not eligible. You know, well, they're eligible to go to work, but they have a difficult time sometimes finding work. So as a result, if you employ an unemployed veteran, you can get a bonus for it. People who are on TANF. TANF is the temporary assistance for needy families. Those needy families often are trying to support larger families or families that have not had the ability to get out of the situation they're in. Sometimes they are families that have suffered, you know, divorces, losses, abuse. Okay, so as a result, they are in a situation where they can't get out of the situation. They haven't been able to get out of the situation they're in, and as a result, they are in need of assistance. So what will happen is if you employ one of the people on TANF, you get a benefit for it. SNAP is the food stamp program. So if you have somebody who's on the food stamp program and you actually employ them, you can actually get a credit for it. Designated community residents. This is a living in empowerment zones or rural communities. An empowerment zone is a lot of times in larger cities. There are referred to as the project areas or the slums or things like that. Okay, that's what they get referred to in a lot of cases. Chicago has the projects. Okay, I remember them very well because I would drive by them as I was going to school. They're a group of high-rise buildings that were created specifically to accommodate low-income families. So,
I knew. Yeah,
got it.
Thank you.
And so what ended up happening is anybody in those areas specifically, they have a hard time getting jobs. Okay, so they know that these are areas that are distressed areas. Now, by a distressed area, it means low income area that cannot recover from an immediate change. And as a result, anybody who gets employed from those areas, it helps the area itself. Okay, anybody getting a job in that area. So they viewed it as an empowerment zone. So in other words, you were trying to employ somebody in those zones or a rural area. A lot of times these are rural counties where, like in Oregon, we have a lot of areas where there is very low population. They're usually large farming communities that they don't have many people in. And if somebody, a business, maybe often has the town which only has one major business in it, and that business goes out, for whatever reason goes out of business, the entire town falls apart. Okay, so what they do is in those rural communities, what will happen is if you employ those people, you get a tax credit for it. Vocational rehab, these are for individuals who need either help or they have had troubled youth, things like that, and they need help with getting jobs or getting started, and as a result, they will allow you a credit if you employ them. Okay. Ex-felons, as we were talking about, Dave's Killer Bread. Okay. Dave knows what it's like to be recovering, to be an ex-felon, and how hard it is for an ex-felon to get a job. And so he actually employs them. Okay. A lot of these people are not violent criminals. What they are is they committed a crime like robbery. Sometimes, they committed a crime because they needed to. By needed to, I'm saying that they didn't have any other possible way to support their family and they felt they were desperate. And so they may have committed a crime, and as a result, they are now a felon. Well, that doesn't mean they're a bad person necessarily. They committed a crime because they made a mistake, they did something wrong, or whatever the case may be. And they need a job. Well, if you give them a job, you can get a credit for it. The summer youth employees, these are the ones, basically the ones living in empowerment zones, that the kids, the teenagers in those empowerment areas, low income areas, they will never, they have a low chance of getting out of those areas unless somebody helps them. So they have summer programs for them, which will allow them to move out of those areas and hopefully get jobs and get experience in the outside of those empowerment areas by allowing summer employment programs. And these are just some of the areas that are created to help these people get jobs, and as a result, you get credits for employing them. Now, one of the special ones, in addition to the regular credit, veterans have a special category, and they actually have a special credit. It's on the same form, but as a form 8584C. It's a work opportunity credit for qualified tax-exempt organizations hiring qualified veterans. In other words, churches and tax-exempt organizations who actually hire the veterans will allow them to get a special credit against their expenses. Okay. That's a great thing for the veterans. The more opportunities the veterans have, the more chance that they get to get employed and get off the streets or get out of the situation they're in. So it's a special credit just for tax-exempt companies to employ more veterans. So those are a list. And again, this is important. these are a non-refundable credit. Okay, the work opportunity credits are a non-refundable credit.
Ryan.
Yeah.
It says the veterans credit is a credit against the employer's share of Social Security tax.
Correct. Yes, that is against the against part of their Social Security tax. Correct. Now that's only for the veterans one.
When you remit your Social Security tax, you can deduct the credit?
Yes, you can deduct the credit at that point, correct. Now, that is only for the veterans.
Yeah.
Okay, that's not for the other categories. That is only specifically for that veterans credit.
Okay.
Okay, that is only specifically for that qualified veterans from non-exempt, from tax-exempt organizations. Okay, that's not from the other ones. Okay, that's only from that special category. Okay, so it is not from all the regular categories. That's only from the veterans who get hired by tax-exempt organizations. And that is specifically a credit against the employer's share of Social Security tax. Okay, and that's why it gets filed on a separate form. That's why it gets filed on the 5884C.
Okay.
Okay. Now, the amount of the credit varies depending on the targeted group that the employee belongs to. So in other words, each one is a different type of need, and so as a result, each one applies a different amount of credit. Okay, so there is a couple of things that will also affect it too. They may actually fall into more than one category too. So they may actually qualify for more than one credit. So let's say it's a veteran who is also an ex-felon or on food stamps. You actually get more than one credit.
Mm.
So they may actually grow the amount of your credit based upon multiple categories. All right. Now that is the work opportunity tax credit. Now, the disabled access credit. This one is for small businesses, which now by small businesses, it actually has certain specifications that it has to meet to be considered a small business. And it's calculated in a specific way that the credit is determined, the amount of the credit. Okay. To start, it has to, where'd my mouse go? Okay. It is the disabled access credit, and it goes on form 8826, and it is for small businesses. And now they have to have certain criteria. Okay. The small business has to be gross receipts less than $1 million. Okay. And have no more, they have to have less than 30 full-time employees. Okay. That's how they determine it. Okay.
Less than 30?
Less than 30. They have to have no more than 30 full-time employees during the preceding tax year. So they have to have less than 30 full-time employees. put this on the next line here so we can see that. Okay, those are the two requirements. Now, to calculate it, what ends up happening is it's a up to a $5,000 credit. And how it's calculated is this. You are responsible. Now, this is for retrofitting your building, okay, to allow access to disabled persons. It must be for repair, must be to retrofit buildings for compliance with the Americans with Disabilities Act. Okay, so in other words, wheelchair access, ramps, that sort of thing. And what it does is it says you are responsible. You pay the first $250. You pay the, I can't type. You pay the first $250. And then you get back, you get a credit for 50% for the next 10,000. Okay, what does that mean?
Okay, yeah.
That's how you get the $5,000.
Yeah.
Okay, so let's say that they spent $13,000, 13,250. Let's do it that way. So this is the examples. They spent 13,250 to retrofit this building. Okay, so to start, we take off the 250. Okay, because that's you pay, right?
Yeah.
So that leaves 13,000, right? So we divide that by 50%. So it's half of 13,000. $6,500, right?
Yeah. Yes.
So that is a $6,500, right? And what's the max credit?
5,000 only.
So max is 5,000. So the credit they would get equals $5,000.
Yes.
Right?
Yes.
Okay. You understand how that works?
Yes.
Okay, perfect. So it's really easy to calculate. It's not hard at all. I think we lost Amanda.
Yeah.
It's not hard to calculate. It's very simple, but it's very important because it's small businesses. Now, again, it is a non-refundable credit, which is very important.
Yes.
Okay. And you take off, like I said, you take off the first 250, divide the remainder by 50%. Yeah. So here you divide that by, divide the 13,000 by 50%, and you get 6,500. The max credit is 5,000, so you get a $5,000 credit for the disabled access credit. All right.
Okay.
All right. Employer Social Security and Medicare taxes paid on employee tips. Now this one is actually a complicated tip. It's based on people who don't typically report their tips. Okay. Restaurant and food beverage establishments can claim a credit for Social Security and Medicare taxes paid by the employer on certain employees' tips. The credit is equal to the employer's portion of Social Security and Medicare taxes paid on tips received by employees of restaurants where tipping is customary, as an employer must meet both the following requirements to qualify for the credit. Employees who receive tips from serving food or beverages have paid the employer Social Security and Medicare tips on taxes on those tips. Now, it doesn't apply to anybody such as hairdressers, chauffeurs, tipped employees. Okay, so in other words, they get a credit on what they paid on tips to Social Security. Now, the problem for this one is a lot of people don't report their tips. Okay. As we know, tips are a great thing when you don't report them. Okay. Unfortunately, that's not what you're supposed to do. You're supposed to be reporting tips no matter what. As we know, a lot of people do not. So as a result, we do not, employers don't have the opportunity to get this credit because a lot of employees don't report their tips that they received. Okay. This is why a lot of companies actually do shared tips and pooled tips, because they then can report those tips that they pay to Social Security for food, that sort of thing, allowing them to get this credit. Okay. So that's why sometimes they do a pooled tip donation. Okay. All right. And it's not a complicated in that sense. It's just really hard a lot of times because most people don't report their tips. Okay. And it cannot, if they paid it, it has to be, they can do it off of the estimated tips too, because as long as they're paying the tax on them. So if the employer reports estimated tips and pays the tax on them, they can get that credit, but they have to pay the estimated tax. All right. So that one is, you're not going to need to know too much on that one because it's actually not a credit that's claimed by a whole lot of people. This one's really important. The disaster relief credits. After, in 2017, they were hit by 3 hurricanes. Okay. Hurricane Harvey, Hurricane Irma, and Hurricane Maria. So what they said was a lot of people were out of work. A large area was affected by it, and so as a result, a lot of people were unemployed because the businesses were not eligible to be opened. They had to be repaired first before they could open back up. So what happened is a lot of people were not eligible to go to work. Well, some of the employers actually continued to pay their employees a wage so that they were not destitute, because it may be months before they were able to go back to work. Okay, so some of the employers actually continued to pay some of their employees wages. That was just a great thing that they did. Well, to make up for it, they were given a credit as an eligible employer. So it is a business who continued to pay their wages after the employer's business became inoperable because of the damage due to the hurricanes. Now, the businesses may claim a credit up to 40% of up to $6,000 of qualified wages paid to or incurred for each eligible employee. That's actually a pretty good deal. Okay.
What do you call that credit?
That is the disaster relief credits. It was part of, it was part of the Disaster Tax Relief and Airport and Airway Extension Act of 2017. Okay. The southern part of the United States got hit by 3 hurricanes, and it did a lot of damage. And so people were unemployed, so they allowed them, some of the employers continued to pay them even after the time that the hurricane had occurred. and they were allowed to get up to 40% of $6,000 of qualified wages. So that was a great deal for actually both sides. All right. The Small Business Health Care Act. This actually came about to credit for small employer health care premiums. It came about because of the Affordable Care Act. Okay. It is not part of the general business credit. It is a separate entity. It does not go into that umbrella one. And it was specifically targeted to employers with low and moderate income workers. And it phases out as average annual wages increase. Okay, there are a lot of things that have to occur before you're eligible to get it. Okay. An employer must have fewer than 25 full-time employees. The average annual wages of the qualifying employees must be less than $50,000 in 2017. Okay. The employer must also pay at least 50% of the employee's premium costs. And the employer must offer coverage through the shop marketplace. That's the small healthcare opportunity place, the actual shop where you would go find your healthcare coverage, the online service. They must offer it through the shop service in order to qualify. Okay, and the credit is phased out completely for employers with 25 or more full-time employees, or those whose annual average yearly wages are $53,000 or more.
It's $54,000 or more in 2018.
In 2018, $54,000 or more.
Yeah.
All right. Now, the small business healthcare credit is worth up to 50% of the employer's contribution towards the employee's premiums. Okay. And it's up to 35% for tax-exempt employers. Okay. Got that down?
Yes.
So, it is a tax credit that was brought about for small businesses to give them an incentive to offer health care even when they didn't have, because they weren't required to have it if they had less than 50 employees. Okay, the Health Care Act, the Affordable Care Act said if you have 50 or more full-time employees, you have to offer this. Okay, you have to offer the health care. This caused a lot of companies to have less than 50 employees all of a sudden. As a result, smaller companies had no reason to do it. They didn't want to do it. So to get them incentivized to do it, they gave them a credit. It is saying that if you have less than 25 full-time employees, and these are for the low to middle income families, so your employees have to have a regular less than $53,000, $54,000 in 2018 annual income, then we will give you a credit for it. So your credit, if you pay their premiums, is we will give you a credit of half of the premiums paid. Now that's actually not a bad amount when you think about it.
Yeah.
Because that's saying if you paid $3,000 in premiums, we're going to pay you, over the year, we're going to give you a $1,500 credit. Okay.
Yes.
That's actually a pretty good deal for those small businesses, and it will give them an incentive to actually do it. Now, in most cases, unfortunately, A lot of those small businesses, though, didn't meet the
Offer.
$53,000 minimum.
Okay.
Because remember, it has to have that minimum wage, that average wage. So even though they have less than the number of employees, a lot of small businesses have a higher wage for their employees than the ones that are a larger company. Okay. The reason is they're a small business. Okay, they're usually the the owner's business and just the few employees that work for them. They usually collectively have a higher income. Okay. So that's one of the requirements that has to be met, and sometimes that's difficult for those small businesses. But a lot of times, if you do have a small manufacturing business or something like that, you can do it. So, fewer than 25 full-time employees, annual wages of qualifying employees must be less than $53,000 in 2017 and $54,000 in 2018. The employer must pay at least 50% of the employee's premium costs, and he's got to offer coverage through the shop marketplace in order to qualify. Those are actually just pretty simple guidelines when you think about it. All right. DPAD. DPAD came about because we wanted to keep things in the United States. Okay. It came about in 2004 because we wanted to make sure that manufacturing would stay here in the States. And it has changed over the years. And in 2017, it was equal to 9% of the qualified production activities or the adjusted gross income of an individual, estate, trust, or other taxpayers determined without regard to the DPAD. So what this means is this. Certain companies that manufacture goods in the United States or sell or lease or licensing items that have been manufactured in the United States or selling or leasing or licensing motion pictures that are produced in the United States, construction of real property, engineering and architectural services relating to a U.S.-based construction project, software development and production in the United States, production of water, natural gas, and electricity in the U.S., and growth and processing of agricultural products and timber. These are the main things. In other words, if it grows here, gets produced here, that's what they wanted. They wanted to encourage this. So to do this, they would allow up to a 9% deduction credit for performing duties which allowed you to produce an item or product or property here in the U.S. Okay, not doing it abroad. Now it had certain limitations. Okay, it can't be just assembled here. Okay, and it cannot be just, so in other words, it wasn't stuff that was just, it actually had to be produced here. Okay. So in other words, if you were building an object, it cannot be just everything is built outside the country. You just get the final couple of pieces here and put it together and say, oh, it was built here. Okay, because we had a couple of companies I remember try to do that and claim it. But no, this was for domestic production activities deduction. Individual taxpayers, including partners and shareholders and pass-through entities and beneficiaries of the trust, can claim the deduction as an adjustment to income on the Form 1040. C corporations claim it on the Form 1120, the regular business tax return. Okay. So what ends up happening is it is limited to 50% of the Form W-2 wages paid to employees for the entire year. So in other words, you had to take a sum of all the wages. So if your production costs, say, were $500,000, you would take 9% of that. Okay, or $50,000, what is it, $45,000? Now, it is limited to 50% of the Form W-2 wages paid to employees for the year. So if your employees, however, didn't make at least $45,000, okay, you weren't allowed to claim that amount. If they only made a total of $35,000, that was the most you could claim. That was the limit. Whatever 50% of the wages. So they would have had to have made, to claim $45,000, they would have had to have made $90,000 in W-2 wages, okay, for all your employees. This was mainly to limit small businesses, because if you have a manufacturing company that has, 500 employees, you're probably going to make it no matter what, okay? But if you only have 2 or 3 employees, you actually have to watch what you're producing, the amount that you're making off of the production versus what their wages are, okay? But that's just a limiting factor for the wages, for how much you can deduct. Now, what does that look like? Okay, let's take a look here and figure it out this way. So you are allowed to take 9%. Oh, let me type that out again. 9% of the manufacturing cost. Now, that's a little bit complicated to figure out. Okay. It's all of the qualified activities you'd have to go into. There's a whole list, but that's just basically, this is kind of to sum it up. There are a lot of calculations that go into this. It's a very complicated calculation. Okay, but more or less, it's 9% of the manufacturing costs. So if your manufacturing costs were, say, as I said, $500,000, let's do something like this, you would get $45,000. So 9% equals 45,000. Okay. Now, that would be a great deduction, but it has a rule. The rule is that the credit amount must be, it's limited by, it must be 50% of the total W-2 wages of employees. Okay, so what that means is your employees, some employees, in this case, would have to make at least $90,000.
Mm-hmm.
Okay, because 50%
It's 45,000.
is $45,000. Okay, now if they only made, say, 80, let's say they made $50,000 total, right?
Yeah.
In wages times 50%, that would be 25,000.
25 only.
So that would limit, even though that they had the 9% equals $45,000, it would limit it to $25,000 is all they could claim.
So they will receive 25,000 credit only.
Yep, because it's limited by that. So if they, even though they had a $45,000 credit that they were eligible for because of their expenses, they didn't have enough in domestic production. So as a result, they didn't pay enough. What they were trying to do is make sure that you were paying U.S. employees. Okay. So if you didn't have enough paying U.S. employees, this means that they were having to produce somewhere else. Okay. They have these products that they're selling, but their local production only cost them, they put it together with only, 3 people, something like that.
Okay.
So they didn't have enough people locally producing it. They had it being produced off in China somewhere, right?
Okay, yeah.
And so the production wasn't U.S. based. Their production was foreign based. So as a result, it was limited to however much you were paying in wages. So if you were not paying enough wages, 50% of your total wages, that was the limiting cap. So yes, if you had enough employees, and this was, say, $250,000, right? So
Yeah.
this was $250,000 times the 50%. Well, great. That's what? $125,000? So great, no problem. You made it by a long shot. So you'd get the whole $45,000 credit. You'd get the whole $45,000 credit. Okay, because you knew you were employing enough U.S. employees.
Yes.
But that was the idea, is to make manufacturing occur here in the United States.
But in 2018, only agricultural and horticultural
which is, right, raising of cattle and that sort of thing.
The horticultural, raising
cattle and that sort of thing, yes.
Cooperatives are allowed to claim it.
That's because they were doing away with it.
What is hybrid deduction? Allowing agricultural cooperatives to continue to claim a hybrid deduction in 2018.
I'm not sure. I'd have to look up. I'd have to look up what the hybrid deduction is.
Yeah.
Okay. But now you understand how that works?
Yeah.
And they were limiting it so that they could pretty much guarantee that it was being claimed by U.S. employees. Okay.
What about the new 199A deduction using the old 199 BPAD deduction rules?
I have no clue. I got to look it up. So
yeah, section 199A, qualified business income deduction.
Okay, yeah, I'm gonna have to look it up.
Okay.
Okay. Now, there are certain things that do not qualify as production activities. Things that were domestic, like just they were considered cosmetic. So in other words, it actually it was things that actually, it meant you had to actually build the building, not just like paint it and do drywall or something. Okay. You actually had to do construction on the building. So construction services actually had to be real construction services. Those leasing services or licensing items to a related party. In other words, you can't just lease them to another department within your own company. That was part of the things that several of them tried, is they just leased it to another business that they were related to try to get the credit. Because it is a good credit, by the way.
Yeah.
Okay. Selling food or beverages prepared at restaurants. Okay. That did not qualify. And you had to actually produce the energy. You couldn't just transmit it or distribute it. You actually had to produce it. Okay. And service type businesses did not qualify. You actually had to, it was designed to be for manufacturer of things within the United States.
Okay.
Okay. Now there are a series of really strange credits. When I say strange credits, I mean credits that are not normal. These are ones that only a few businesses would qualify for because they are out of the ordinary. So they're very specialty. Biofuel producing credits. There's only companies that actually produce biofuel, biodiesel, that sort of thing. A credit for increasing research activities. There's only so many research firms. Low-income housing credit. Again, there are only so many places that actually lease, rent, or manufacture low-income housing. Enhanced oil recovery credit. This is for places that are like drilling opportunities that are going back on the previously drilled out wells and recovering more oil out of them.
Again, enhanced
oil recovery credit. So in other words, they're going back to the oil fields that they said no longer have any oil in them. And, they're just sitting there dead, more or less, right? Because the oil pumps don't have any fuel coming out of them. Well, they've discovered that they're not dead. There's still oil down there. They just have to get it a different way. It just takes a little more effort. It's not just pumping to the surface. They actually have to pump water into it, and the oil then comes to the surface, kind of thing. So that's an enhanced oil recovery credit. Credit for employer-provided childcare facilities and services. This one's a big one. Very few employers actually provide childcare services on site, and they should. I think almost everyone should. Okay, it would make things so much easier, right? If you had childcare on site, that'd be awesome. In most cases.
In the Philippines, we have that.
It makes sense to do that. It doesn't make sense not to. Low sulfur diesel production credit. No, that's for cars so they don't produce sulfur emissions out of their exhaust. If you actually can change it, the amount of sulfur production, there's a credit for doing that.
Again, low sulfur.
Low sulfur
emission.
Diesel fuel production.
Diesel fuel production.
Okay. Now, again, they're not even listed specifically on the exam specifications. So they may not even appear on the exam.
Okay.
So, distilled spirits credits. So in other words, distilled spirits are alcohol. Okay, alcohol production. So there's a credit for actually producing alcohol depending upon how you do it. If you do it the right way, you can get a credit for it. Energy efficient home credit. That one's a big one because there are certain manufacturers, home builders, who build efficient homes, energy efficient homes. Others do not. They're called green home builders.
Yeah.
Okay, that one's a big one.
Rhoda's house is green home.
A green home. Yeah. And unfortunately, too few people actually take advantage of that. And there are only a few builders who will actually do it even.
They are energy saving.
Yeah. Alternative motor vehicle credit. In other words, it is the electric cars, the hydrogen-based cars. They have them that you can actually run a car off propane, biodiesel, anything of that nature. Okay, so if you do that, you can get credit for it, or if if your vehicles do it. That's why the school buses are actually privately owned, They're not owned. They're actually they're not actually part of the school district. They're actually employed by the contracted by the school district to work for the school district. Well, those buses they use, a lot of them will say powered by diesel, by biodiesel. They get a credit for all those buses being powered by biodiesel. So
last time a customer went to Walmart and asked for a credit. If I do not know about it. He bought a car. Yeah. He said there's a credit for that car.
That's very electric cars. Yeah, electric cars. There are at electric cars you can get a credit for. The hybrid cars you can get a credit for.
Yeah, hybrid. That's his term, hybrid.
Yep, the hybrid cars are the ones that have an electric motor and a gas motor. That one will actually power the other one if the one is if it's out of electricity. It'll run on electricity unless it's out of electricity. Then there's a gas motor which will power it until you can get electricity again. So that's a hybrid car.
Yeah, one of my coworker bought that hybrid.
It's a great way to do it.
Because of the credit.
The only thing that's bad, they don't actually pay for themselves. They're usually more expensive to get than the amount they're saving. But hey, it helps. Everything helps. A credit for employee differential wage payments. In other words, if you have to pay people a differential in wage because they're bilingual or whatever. Okay. Here's an important one. Qualified plug-in electric drive motor vehicle credit. In other words, if you have an electric motor on your car, if you have that specifically will get you a credit. So it's got the plug-in motor for your car, because there's some that you can actually install aftermarket. Okay, so, and then like I said, there's a whole bunch. Most of them are in regards to biodiesel, things like that, renewable fuels. There are a couple of different ones. There's one called an orphan drug credit. Orphan drugs are ones that are difficult to produce. In other words, let's say it's a drug for a specific illness that is not going to make a whole lot of money. Okay. It cures something like, I don't know, something that only a select few people have.
A rare disease.
A rare disease. Okay, so it's not going to be worth the billions of dollars that it takes to produce it to that company, right? To the pharmaceutical company, it's going to cost them billions of dollars to produce this drug, but the return on it is not going to be a whole lot. I mean, when you think about it, you're not going to get a whole lot out of it. So they have no real incentive to do it. So as a result, they will instead let it go. Okay, they'll release the drug to somebody else. Okay, and when they release it to somebody else, it's considered an orphan drug. It's not owned by anybody anymore. Okay, well, there are companies that if they will take it up and continue to manufacture the drug in the hopes that it will now be produced, they will get a bonus for it. Okay.
Yes.
And new market credits, that's if you're expanding into things like areas like low income areas, things like that, different things to allow research and innovation. Again, the small employer pension plan startup costs. So if you start up a pension plan, that's great, because pension plans have pretty much gone away. Well, they like pension plans. That helps with retirement. The empowerment zone credit, that one's an important one. Okay, the empowerment zone, you hire somebody in one of these areas where it's a rural area, a distressed urban area. It allows you to get a business credit for doing it. Okay, and like I said, there are a bunch of credits. There's a ton of credits out there that are business credits. You just have to go find them. Okay, and they're not always not always easy to find, but they can count for a lot of money against your tax bill. All right, some are refundable, some are non-refundable. Okay, and that's really all there are on the actual business credits. All right, so let's go over that, just kind of recap it. Business credits, let's start off. There is a net operating loss. Net operating losses are caused and can be moved forward or moved back depending upon what it is. And they work like a credit in a sense to previous years or prior years, right? And that's how you carry that loss forward or back as a credit onto a future year or a past year. Okay.
Yes.
Okay. Then we have the business credits, right? The business credits are awesome. They are much better than a regular deduction because a credit says you get this many dollars off, right? It's not just a portion. Deduction just means you get this percentage off, where a credit says you get this many dollars, this much off. Everything you put in, you get off in that sense. Okay. And the general business credit is the umbrella credit. It's the form 3800 general business credit that everything kind of falls under. Okay, that's the page that you do the individual forms on, and then the general business credit page, the 3800, is where they all get put on. Okay, that's the aggregate form where they all get stuck on for the reporting. Okay, do you understand what that means?
Yes.
Okay. Now, general business credits, just like a net operating loss, can be carried forward and can be carried backwards in some cases. Okay, it depends upon the credit. All right. So it can usually be carried back 1 year, and it can usually be carried forward, and it's normally 20 years.
20 years, yeah.
20 years. Okay. So, we'll check on that to see if anything's changed on that. But it's normally carried forward 20 years and back 1 year.
For
Okay.
general business credit, it is still for up to 20 years.
Up to 20 years.
Yeah.
Okay. Now, the investment credits are what you're doing to a property to make the property better. You're either restoring the property, making it more energy efficient, or doing something with coal, solar, wind, geothermal, something like that. Okay. You're investing in your property to make it more energy efficient or more up to date. Okay. The work opportunity credit, it is one that you are hiring somebody who is going to work with you to help you out, who is normally in a bad situation, an unemployed veteran, somebody on TANF, somebody on food stamps, an ex-felon, something like that. Okay, pretty straightforward.
Yes.
Okay, the disabled access credit is a company, and it's a 50% up to $5,000. Okay, up to $5,000 credit. You're responsible for the first $250, and then 50% up to a full $5,000 credit for changing your business to make it in compliance with the Disabled Americans with Disabilities Act. In other words, wheelchair ramps, wheelchair access, the bars, so you can get up and down in the bathrooms, that sort of thing. Okay.
Yes.
Pretty simple. The employer, Social Security and Medicare taxes paid on employee tips. You can get a credit for it. The specific amount is up to, I believe it's 50% of it, but I got to double check on that one, on the amount. Disaster relief credits. During 2017, the South was hit by 3 major hurricanes. Okay. One right after the other. As a result, a lot of people were out of work because businesses were destroyed. So if the business owners continued to pay their employees even after they were no longer able to work, because the businesses were inoperable, they were given a credit of 40% up to $6,000 in qualified wages for every eligible employee that they continue to pay the wages on. Okay, that's awesome. For small businesses, and this was to encourage small businesses of less than 25 employees to comply with the Affordable Care Act. If you had less than 25 employees, low income, so less than 53,000 in 2017, less than 54,000 in 2018, the employer must pay at least 50% of the employee's premium costs, and they must offer coverage through the shop marketplace in order to qualify. What ended up happening is if you did this, then 50% of the then you were allowed tax credit up to 50% of the employee's contribution towards the premium costs. So basically, that's not too bad. So if you paid $1,000 in the employee's credit premium, health premiums, 500 of it was a tax credit. Okay. Now, the domestic production activities deduction, this was designed to keep things working and farming within the U.S. Okay, manufacturing in the U.S., farming in the U.S. So if you were building something here, farming something here, licensing, leasing, manufacturing, construction of real property, engineering, software, production of anything in the United States, we gave you a credit up to 9% of the manufacturing cost. It had a requirement that your wages you paid equaled 50% of the wages had to equal what the credit amount you were getting was. We paid up to 9% of your manufacturing costs, so whatever that manufacturing cost was, it had to equal at least 50% of the W-2 wages you paid. So that meant that you were at least employing people in the United States to work to make these things. And that's what they were working for. That was a test to make sure you were doing this correct within the United States. Okay. And like you said, it's now, oh, by the way, 1099 wages do not count. It had to be W-2 wages. All right. And that was to show that you were doing stuff within the United States. And then they had all of the obscure business credits. These credits are ones that there are a whole bunch out there. They're specialty credits like the biofuel production credit, the low-income housing credit, enhanced oil recovery credit, you name it. Low sulfur diesel fuel production, distilled spirits credit. Like I said, there's a ton of these. And you can qualify for all of these different credits. The orphan drug credit, new markets credit, credit for small pension, empowerment zone, the child care credit for employers that actually have on-site daycare. I can't help it. I really do love that one. I think that one's probably one of the best ones ever. Okay. These are credits that a lot of companies are eligible for and actually should probably get, but typically don't. Okay. And also, if you're an expert in those, that's an important thing. If you're an expert in these, that's a really good thing if you have if you have companies coming to you asking for help, because if you start giving them ideas on how to get some of these credits, oh, you can make a lot of money off of them. Okay, because advice for that, you become a tax strategist, try to help them with that, oh, you can make a lot of money off that. All right.
Okay.
It's 1 o'clock already. That made it through all the way through Unit 6. I almost want to start Unit 7, but let's not. There's only you and I here. So let's start let's start Unit 7, because we've been losing people throughout the day, because I know we had a bunch of people who came and go. Let's start Unit 7 on Friday.
Okay.
Sound good?
Yeah.
All right. So that was good. We went through an entire unit today. That's good. That's the way it should be. And we're going to have to take that kind of pace now for a while going forward. Okay?
Okay.
So, Unit 7
on
Friday.
Bye.
All right. I'll talk to you on Friday then, dear.
Okay.
Okay. All right. Bye-bye.